Welcome to Smart Strategies for Life After 65. Are we ready for the wave? Looking around the room at this distinguished audience, thank you for joining us this afternoon. Very distinguished indeed, which I know will contribute to a great session this afternoon. Someone contributed to the fact you must all know this will be the best session of the conference, so thank you and well done. My name is Ralph Stewart. I'm the founder of Lifetime Retirement Income, and I'll be directing traffic this afternoon. Thanks to the FSC for facilitating this opportunity to talk about share, think and contribute to shaping retirement now and in the future. Much talked about retirement wave is approaching us at lightning speed. In fact, it's probably better referenced as the retirement tsunami, and the warning's over, it's here now. And while yes, it's about the future, it's also about the now. Please don't be under any illusion whatsoever. There are over 1 million retired folk in New Zealand today. Deeply, deeply grateful and respectful for NZ Super, but at the same time, they could live better lives. NZ Super's their stable, it's their mainstay, but it's simply not enough to have the dignity and the freedom you might like to think they could have in retirement. At Lifetime, we spent the last 10 years trying to innovate in the retirement space, and it's not easy, it's complex. You need very patient shareholders. And a regulator that's accustomed to the unknown, and in recent years they've been very supportive and helpful in that context. But for us to be able to progress innovation, particularly in the retirement space, it's going to take everyone in this room to change the lives of retired people in New Zealand, and quite frankly they need that help now. We do have some people to help you as you contribute to our session today, and it's my pleasure to introduce Ian Perera, Convenor of the New Zealand Society of Actuaries Retirement Income Interest Group, a rather actuarial acronym. Welcome, Ian. Please introduce Joe Townsend. Joe, you probably know, Joe is Chief Executive Officer, New Zealand Super Fund. Welcome, Joe. Dr. Patrick Nolan, Director, Research and Policy at the Retirement Commission. Welcome, Patrick. Our plan for today is pretty simple. We've met prior to today. We've got some planned questions in an effort to bring some focus to the discussion today. And then we'll pass over to your good selves, who we know will provide us with insightful and considered questions, and we'll answer those after the prepared ones, I suppose in about half an hour, 35 minutes. So before we start, just a very quick disclosure to the panel. We understand that in your particular roles, it may be challenging to answer some questions, so we fully understand that. And just want to acknowledge we're seeking your experience as individuals in your careers wherever they have been. And thank you for the opportunity to be here today. That's tremendous. Okay, let's begin with the first question for the panel. Here we go. How we preserve our current superannuation construct for the future may be debatable, but right now it's working and it's working well. Notwithstanding, in an effort to protect what we have, what do you think are the biggest threats facing the future of NZ Super?
I think we've made some great progress in recent years in things like KiwiSaver. So we've got what I think is quite a good accumulation phase, but we've got 500,000 KiwiSavers who will get to age 65 over the next 10 years, adding to the nearly 200,000 who are already at that age. And we have not given them enough help to work out what to do with their KiwiSaver balances when they get to age 65. I think it's going to be an issue if we don't somehow give them the confidence to take advantage of the funds they've accumulated. So I really think this lack of ability or lack of knowledge and focus on education about drawdown is a big issue for our overall retirement system.
Education on drawdown, we'd agree with you, mate, wholeheartedly. Joe, what do you think?
So I see that there's mechanisms in place that will support superannuation in the future. I think the big question is just around adequacy. And my experience, I have had 30 years working in the superannuation industry in Australia, is that people don't really worry about retirement until it's almost upon them. And by that time, it can be somewhat too late to benefit from the ability to make small additional contributions over a longer term. So I think, and it's challenging because you don't typically get high levels of engagement when people are younger, but to the extent people are able to sort of look into the future and actually really understand what their level of income in retirement is going to look like and what sort of lifestyle they can expect, there's no real incentive for people early on to perhaps contribute more. So overall, I think, the basic constructs are there. It's about how can they potentially be maximised in the future.
Thank you. What do you think, Patrick?
I agree with all of that, and I think it's a very important question. Just as a sort of an international lesson, I don't know if people have been following, but the French government collapsed earlier this week. And if you look at what was behind that, it was basically they lost control of their pension system. And, they're having trouble with their funding, their spending, and they've got very high levels of public and private debt. And so what that shows is that these discussions are real, and that if we don't get to grips with these sort of things, the sort of catastrophic situation you can end up in as a country. Now, we're a long way from that in New Zealand. We're very fortunate. Our system's much more coherent. It's much more cost effective. We've got better demographics. So we've got a lot on our side. But the concern is if we don't get to grips with some of these issues now, in 10 years, we'll be where France is now, or where people are in the UK or some of these other countries. So these are really important issues. So we've got some time now and we've got to use it.
Yeah, good. So it feels like, in trying to summarise in a consensus sense, recognising the needs of those approaching retirement and ensuring they're educated about the importance of drawdown. There's the younger people and making it aware for them the importance of contributing as much as they can. And there's the issue of the structure itself and acknowledging the challenges others are facing that could face ourselves. Pretty good segue, really. It takes us to adequacy and sustainability. In the Mercer CFA Institute Global Pension Index 2024, New Zealand received a B overall ranking. That was an A in governance, regulation and operations, a C plus in inability to provide sufficient retirement income and financial security, and a C plus in overall viability. To our mighty panel, where should New Zealand focus to improve our sufficiency and sustainability scores, and why, please? Who's going to be brave? Thanks, Joe.
I actually think one of the really important pieces of it is the importance of advice. Now, the challenge around advice is particularly where you've got people that aren't engaged, the younger people, that don't necessarily want to pay for advice. So you have to try to do it at scale, and you can certainly do it through things like calculators and things like that, but that can help people get a greater appreciation of whether or not, or what their level of individual adequacy can be or will be likely in retirement. As people approach retirement, their actual needs become more individual, and so scaled products and scaled advice becomes less relevant to them. And so I think one of the really big challenges is to how do you actually help people get the best outcome without it actually costing an arm and a leg, and sort of what are the mechanisms by which they can pay for that.
How do you think we can draw those linkages to the sustainability challenge?
Well, I look at sustainability from, the growth in the system overall, and, the more dollars you've got invested, the more it supports local capital markets and wealth creation. So to me, it's that sort of link to sustainability of the system overall. Because if you look at the growth in the Australian market, Australia's GDP is 7 times larger than New Zealand, but Australia's stock market is 20 times larger than New Zealand. And certainly a big contributor to that has got to be the level that mandated superannuation has grown over the past 30 odd years and actually, supported the growth in capital markets.
Yeah, sound. Thank you, Joe. What do you think, Ian?
Yeah, I mean, in terms of increasing our scores, well, there's an easy one. We get 2 out of 10 for income streams. Yep. We are ahead of Argentina, I think, who got one out of 10, but otherwise, so I think that's one way to do it. Though I would say that I think it's still important to have some flexibility. I don't think the answer is to say everyone has to go into an annuity. We've got people with very different circumstances, I think we need income options which can allow for the variety of different needs of Kiwis.
Okay. Thank you, Ian. What do you reckon, Patrick?
Yeah, I guess I see sustainability in a, sort of a more general sense, and that, retirement income systems are really based on promises. And the system has to be able to be consistent and coherent and trusted over time. And if we start to break down trust, or if the public start to lose confidence in the system, then I think that's when you can get real problems. And that points to, again, this goes back to the France example. This is why, as well as thinking about like the mechanics of the design of the system, it's really important to think about how we make changes to the system and how we take people with us, and actually how the system sort of goes to where people need it to be. Now, having said all that, in a more technical sense, there is also a big question around the balance between what we call pay-as-you-go and save-as-you-go. So the pay-as-you-go is the government bit, that's the public pillar. So that's your New Zealand super, that's your Tier 2 and Tier 3 benefits. And save-as-you-go is KiwiSaver and your other private savings. And so the really big question and the debate we have to be having as a country is the balance between those two things. Because the pay-as-you-go, the sort of the risk and the fiscal cost of demographics fall on the government's budget sheet. With save-as-you-go, it's actually people are providing for themselves and they're smoothing their incomes over time. So they're very different types of systems, and they have pros and cons, and the Australian system is a good example of one where there's much more focus on save-as-you-go. So, and I do think, as Joe said, that's very good in terms of you get deeper capital markets and it supports productivity and capital deepening, the stuff that Oliver Hart, which was talking about yesterday. The flip side of that is, though, it can create gaps, because if you're not working, there's not a lot to contribute from. So this is some of the challenges. But I do think we have to have a sort of a more of an open debate about those types of questions.
Can I just
Go on, Jo.
off the back of that, if I can just talk about the New Zealand Super Fund for a moment, because it is sort of, New Zealand Super Fund is an example of save as you go on behalf of the government. But just to be clear, the New Zealand Super Fund, we're actually the asset management firm for the government. And so we are part of the solution to the future cost of the government's cost of funding universal pensions.
Yep.
But at our peak, we will only fund 20% of the cost of New Zealand super pensions. The rest of it the government will have to pay as they go. So the super fund is never set up to fully fund pensions in the future. So yes, while KiwiSaver is save as you go, there is a small portion of the New Zealand super pension that is save as you go, but certainly the largest part of it is pay as you go, and the government is going to have to raise those monies in nominal terms in the years to come.
Got it, mate. Got it. So NZ Super is save as you go and the government is pay as you go. Patrick, you're an advocate for having the conversation. Mm-hmm. How do we do that?
Well, I guess this is where I know some of the politicians today have talked about political consensus and those sorts of things. I think it's just a question of we just have to be honest with people, and this is where I think your work, Ralph, around sort of home reversion and stuff comes in. Actually be honest about what the government can do and what it can't do, and maybe where actually people do have to start saving for themselves or taking more responsibility, or if you've got equity in the home, maybe you should be using it, those sorts of things. Now, these are not easy things to raise, and no politician's going to want to come out and say you should have to draw down the equity in your house to pay for your healthcare or anything like that. But actually, we just have to recognise that that's the real world, and that's the world we live in. Otherwise, you end up in this sort of fiscal fantasy land, and you do end up at like I keep banging on about France, but that's the alternative. And we're very lucky in that we're 10 years back from where some of these European countries are. But if we don't start to be a bit more honest, we will be in that position and not that far away.
No, totally, Patrick. I mean, in New Zealand today, of the odd million or so above 65, nearly 300,000 own their own home, have NZ Super and very little else, and are trying to make ends meet, I should say. Totally, Patrick. Any other comments on this space, mate?
Yeah, I just think over this issue of having retired people who are asset rich and income poor, and a sort of a younger generation that maybe relative to previous generations have got less assets, certainly less property assets. It's not great for, I guess, social cohesion.
Yep.
And the one thing which is really important for, I guess, retirement income policies over the long term is things like is social cohesion. We need I guess country needs to keep
totally.
continuity about how it deals with things. Otherwise, things
totally.
can turn to France.
Mate, it's interesting in our small world that sustainability of NZ Super is a fairly sort of complex conversation for a 75-year-old. But my goodness, they worry about it. Every time they hear about the radio, some sense that NZ Super might be interrupted is really hurtful to them. They really struggle. We better keep going. We're now turning to asset management and the support, how asset management supports a demographic that is already older and growing older. In essence, the old chestnut, should asset allocation change as you get older? So, team, how should asset managers construct their retirement strategies for an older demographic without the opportunities and what are the opportunities and what are the issues? Joe, thank you. You've been shooing here.
The challenge around having a more conservative mindset and risk appetite in retirement is that at the point of retirement, most people are likely to live 20 to 30 years these days. And so whilst they still do need elements of growth in their portfolios, they might be very adverse to the volatility that can actually bring. The other thing about asset management and designing products for retirement is that it is a very different situation from the accumulation phase, where you can make a really strong case for having a default product that represents a large cohort of people. It becomes a much more nuanced product requirement in decumulation than it is in accumulation. And I was surprised, I must tell you, when I came to New Zealand and I actually learnt that KiwiSaver doesn't have inbuilt decumulation products. I mean, this is a discussion that has been ongoing in Australia for quite a long time now, and it's a really difficult problem to solve, but certainly they have been tackling it. A lot of that has been driven by regulatory change in order to get that happening. But there are all sorts of potential things you can do from an asset management product perspective around things like trying to put floors in terms of volatility, or potentially trying to have a minimum level of income in retirement. All these things cost money, and they can increase the complexity of trying to explain a product to somebody. But at the end of the day, there's sort of a trade-off between not wanting to have that really high growth volatile outlook and still wanting to get some sort of growth over what might be a long time in retirement.
Totally, Joe. Come back to that. Guys, what do you think?
I guess I think it's definitely a challenge for asset managers, because I think just slicing, saying what assets do I need or strategy do I need over 65, we're looking at very different groups of people within that, and even of the same age. So a 65-year-old in poor health versus a 65-year-old in strong health, you wouldn't want them to have the same asset strategy. So I guess it talks very much for the need of advice of some kind for these customers. So I think for asset managers, being clear about the characteristics of the various funds they've got, so that advisors can then help their customers into an appropriate solution with there being, I guess, no surprises in terms of how the asset solution performs.
Sound. But the notion for advice in retirement, as Joe was saying, is investment management and accumulation is deeply different than decumulation. I'd argue advice is the same in retirement. It's completely different. And we don't see much emergence of people talking about life length, mortality, healthy lives. We just hear about dividing an expected age by a sum of money. Incredibly unsophisticated. What do you think, Pat?
I'm more of a policy guy, so I'll kind of come at it from a sort of a more general perspective. And I guess it's really important to understand the changing context. and that the asset management and the advice we're giving sort of reflects that. We've got 50% of people aged 65 to 69 are in work now. So, that's a big change. We've got really, important changes in home ownership rates on the over 65s, big ethnic changes, a whole lot of changes in what retirement looks like. And so what used to be, almost a one-size-fits-all picture of retirement really has broken down, and it's just going to continue to break down. So the over 65 population is just getting more and more diverse, and the needs are just becoming more and more diverse. So you've got real differences in need between, if you're over 65 and you're working, you own your home, very different position than if you're out of work and you're renting, for example. So just sort of, we really need to understand that change in context.
Yes. And arguably there's a bit of a sea change already occurring in retirees that own their own homes is shrinking every year because more people are retiring with mortgages.
Yeah.
And they're losing that opportunity. To Joe's point, we're sort of early adopters and innovators, so it's an early stage for us. But really take your comments to heart. Our asset allocation models for people aged 60 to 90, 63% growth and 37% income. And then we overlay that with effectively a probability model that helps us ascertain what the asset allocation should be inside a given sort of volatility window, and then projecting that forward to say, based on historical returns, what probability can we have of the drawdown rates that we quote as being successful over 30 years? And we calibrate to about 80%. But I think we're probably the only ones in New Zealand who do that. But heading to the place that you're calling out is, I think, more people need to go to. Totally. Last question before we go to the floor. This thing's flashing, so clearly there's going to be loads, which is great. Topic very close to our hearts, innovation. Team, here we go. Focusing on those in retirement. If you had free rein to try and innovate to resolve the clear and present retirement challenges of today, where might you start? For example, private income solutions to supplement NZ Super, finding an enduring health solution for those aged 65 plus, unlocking home equity to improve cash flows, or just simply making the current rebate scheme universal, not locational. What do you reckon? Ian?
Yeah, I mean, I guess trying to find a holistic way to deliver advice to middle market New Zealand, where they've got some KiwiSaver, they've probably got some other savings out KiwiSaver, they've got a house, and they might be able to use the equity at some point. But the complexity of different pathways that you can use with those assets for an individual, very difficult. If we can see some innovation so that we can just deliver some guidance which takes around all those issues, maybe issues around desired spending patterns and health issues, just get something for middle New Zealand to make sense of the position they're in.
Yeah, good, mate, good. If you had a couple of darts, would you throw it at health over income release or equity release? They're the big issues.
I think for people in Auckland, for example, with enormous property assets and maybe income poor, I think using the house effectively, working out how to migrate maybe to at some point to maybe a different type of living could have, and frankly things like that can free up money to make a difference in medical and other quality of life.
Ian, it is game changing. An Auckland couple on NZ Super of $1,600 a fortnight on $1 million home, they'll release $800 a fortnight and only have to release 35% equity over 10 years. So it takes NZ Hoover from $1,600 a fortnight to almost $2,500 for only 35% home over 10 years. Game changer. Totally. What do you think, Pat?
I'm always reluctant when I'm asked to sort of find silver bullets or, individual levers, just because it's a system. And there's always a risk. If you pull on one part of the system, it's going to create pressure elsewhere. So, for example, if you were to change the New Zealand super settings, change the age of eligibility, then you'd have to really think quite hard about contribution rates for KiwiSaver. So if I could had a magic wand and I could achieve one thing, it would actually be more about governance. So it would be more, we had a political accord in the 1990s. I know very different circumstances, but if we could have another political accord, if we could sort out some of the machinery of government stuff in Wellington, sort of the relationship between different agencies, getting kind of a clearer work plan. And then once you've got the better governance, then you could think about some of these bigger issues around your New Zealand super settings, the future pathway for KiwiSaver, contribution rates, compulsion, and all of that, but really thinking at it from a systems level perspective. However, there are some sort of more immediate fixes you could do, and I know that I think Sarah Badley, I don't know if she's in the room, at Martin Jenkins has done some work for us looking at the gender pay gap, the gender KiwiSaver gap. So I think there's some sort of more immediate things you could do just to try and close some of these gaps, particularly looking around KiwiSaver and parental leave, the interface there. There might be things you could do around innovation and how we're servicing self-employed. So there's a number of smaller issues that you'd want to fix, but for the really big issues, I think you'd really want to focus on getting your governance right first.
Can we ask you at the personal level, same deal, two darts. Is it increasing awareness for decumulation? Is it improved healthcare for old people? Or is it equity release? What do you think? That's you, mate.
Oh, me?
Go.
Sorry. Not sure. Decumulation, as you mentioned, Ralph, I don't think we've got quite 1 million people over 65 yet, but it's coming soon, and that's a big milestone. It's going to have big implications, and I just think we haven't really grasped the need to think about, when people are moving into that sort of drawdown phase, the advice we're going to be providing. It's just going to be fundamentally important, and so I'd throw both my darts at that.
Sound, mate. Thank you. Joe, over to you.
Well, I've talked about advice quite a bit already, and I do think that's important. If I just sort of stay on that theme, I think, just in general education. So I've talked about advice in terms of, people actually understanding what they're heading towards and, to the extent they're able, contribute early and often and sort of give themselves the best chance of the best possible income in retirement. But I think the other piece of it as well is that I'm not quite sure what the data says here in New Zealand, but certainly in Australia, there's lots of studies that show that people actually haven't generally spent enough of their retirement income in their retirement years because they either do not understand what their real capability to spend is, or they have an idea that they want to leave significant assets to future generations. And so certainly where you've got someone who's asset rich and income poor, I do think if you could potentially find some way to release income out of those assets without people feeling like, the home is under threat, for example, that could be a way for people to actually be more comfortable spending a reasonable amount in retirement, and still possibly having something to bequeath afterwards as well.
Sound, Joe. Can we ask the panel, just sort of talking to decumulation alone, one of the obstacles we face to improving people's lives in retirement is that because the majority of retirees have got their home, NZ Super, and not a lot of money, $200,000 or $300,000, and they're age 70, they're going to have to use some capital to get to 90. And it creates such a sort of almost physical barrier to draw down their capital and know that in 20 years' time it'll be zero. But their lifestyle would improve dramatically. How do we get around that one? What do you reckon?
I guess one thing I'd like to think an improvement that's happened this year is the Retirement Commission via Sorted have now got a decumulation calculator, which is designed in a very easy way to show what is possible, various different options in language which is, and I was partly involved in this project, is very consumer friendly. So they removed almost all the technical phrases, which an actuary like myself would have included, and tried to make it plain English. And I think that's a real positive thing. Great. And that can be used to decumulate even smaller sums, 100,000, 200,000. It's got, so I think that's a great step forward.
And a great sort of an asset for older people who do use technology. They really do. It's a good idea. What do you think, mate?
Yeah, I mean, it's hard, isn't it? I mean, you just keep coming back to advice. I mean, we've actually, just to confirm what Joe was saying, we, in our financial capability survey, we have a sort of a survey that we sort of are regularly looking at these things. And we do find that people aren't spending enough in retirement, and you can understand, because you can only, when you're in retirement, there's no chance of getting that money back. You spend it and it's gone. And so people are naturally risk averse and they're cautious. And so this really does point to this as being a particularly important moment in life where advice is important.
Okay.
And so we really have to get that right.
Yeah, sound. Joe, what do you reckon, mate?
Oh, just bang on about advice and education. I don't think I can add anything else.
Good on you. I'll tell you what, we're going to go to questions from the floor. Thank you, everybody. Here we go. First one, and it's from Craig. What would you say is the sweet spot per annum figure for a comfortable urban retirement, Auckland and Wellington? Thanks. Who wants to have a crack at that, puppy? Ian, it's on you, mate.
You're the actuary.
I guess some of the work has suggested that maybe you when you go up work, if you want to have a starting lifestyle immediately after retirement in what we call the go-go years, maybe 80 to 90% of post-tax pre-retirement income would make sense. But definitely what some of the work we've done has suggested, that's how much you need early on. But you won't be spending at that rate in all probability in your late 80s, early 90s, because there's generally less stuff you want to do. So I think, look at benchmarks about what you want to spend early on, but also recognise that later on in your life you may not need the same, just have the same sort of spending needs.
Sound. Pat, what do you think, mate?
I don't really have much to add. I mean, I think Ian's the expert in the retirement income interest group. The Society of Actuaries has done a lot of really valuable work on this. I guess the only thing I'd sort of add, and it's almost a question back to Ian, is around broken, sort of earnings periods. And so this is where we've got 4+4 as being kind of works out about right for most people with KiwiSaver if you work sort of uninterrupted career. But then, for many people, that's not the case. So, we're starting to see sort of having to think about, like, again, this is the diversity point and what that means for, sort of replacement rates and KiwiSaver contribution rates. I don't know, Ian, if you want to come in on that.
I guess a very timely question, because RIG is going to publish some research in that area next week, and we specifically look at the impact of things like maternity leave or withdrawals from KiwiSaver, which due to buying a first home, and the 4% plus 4% construct works pretty well if you've got unbroken service and a typical path of salaries, but it's not right for everyone. And next week hopefully we'll publish that paper which suggests maybe slightly higher is appropriate for median. The one thing I would say is that what's right for median New Zealanders is not necessarily right for, say, highly paid New Zealanders, because if you want to replace a higher proportion of your income, a high proportion of your income in retirement, and you're a high income earner, national superannuation is going to be a smaller proportion. So the bad news is probably for many people in this room is that it's going to have to be quite a lot more than 4+4 if you want to get 80 or 90% replacement of retirement.
Joe, any thoughts, mate?
Look, I agree with the comments that the panellists have made around, different degrees of income requirements through different ages, and also, the challenges around career gaps. So, there are issues pretty much in every system. So, I don't think anyone's really cracked that nut yet. So.
Yeah, okay. For our 10 cents worth, while we're not advisors, we do tell people about, pretty much like Ian says, about 70% of your pre-retirement income for the first 10 years of retirement, dropping down to perhaps 60. And we find a growing number of people who are using capital drawdown to supplement their income, plus their investment savings, are buying what we call a drop-off. Or in other words, they draw down their income at a different rate 15 years after they started.
And does that assume they own their own home?
Some do, some don't. It's a mixture of both. Given those people in retirement have homes, most would. They would. And that tends to work through. But we still don't see enough of a narrative about is that the notion of advice in retirement has got to go to a place where people don't like to go to, and that is mortality. And as Ian can tell you, mortality improvements are not basic mortality. They change through time. So to my mind, the only way to make advice more effective in that space is for the advisors themselves engage with older people every year, check in, you're a year older, what does that mean for your mortality? How was your health? What were your spending patterns? It's a very active place. You know, there's no one answer when you retire. It's an answer you've got to provide every year.
I mean, the reality is this is a challenge that's got bigger because of improvements in health systems overall. And so I always find it a little strange that, you know, it's considered a problem that you're going to live longer. But the reality is that trying to ensure you've got sufficient income until some unknown date in the future, it can be very stressful. And so if you try to work backwards from that problem, you know, I think that's where potentially some of the products will come into play in the future that will help solve things around, you know, uncertainty of income in retirement and things like that.
Sound. You guys okay to go another question? Great stuff. It's another Craig. Hey, Ralph, what is the role of insurance for retirees? Life and health insurance, thanks. What do you think, team?
Depends how much debt you've got. No, really, because, you know, for someone who's young and doesn't own a home, they probably don't need an awful lot of life insurance. And so, you know, in Australia, a lot of the super funds used to put automatic or default TPD, death, income insurance for young people. And those people just didn't need those levels of insurance, and they had really low account balances, so the insurance fees were actually eating them up. It really is, I think, one of those... It's one of those things where you do need either advice or you do need to look at your own individual circumstances around, you know, if you are retiring with a mortgage, you probably do want to consider, you know, whether or not you want to have enough insurance to pay that out in the event that something untoward happened. That's my view. Yeah.
Sound, mate. Guys?
Yeah, I guess I think this is really an area where you need individual advice because situations will vary so much. I guess generally once you get maybe in your 60s, the risk to your family wealth is that you live too long rather than not long enough. But there will always be individual circumstances where that isn't applicable and advice is needed. Yeah.
Got it, mate.
Yeah, again, I don't have a lot to say on this, but I guess it's really insurance is a way of managing risk, and you know, at the individual level and pooling risk at a society level, and you've got to ask as you get older, your risk profile changes. So, I mean, one thing that we've seen is that people are probably have insurance they shouldn't have. So having life insurance when you're sort of getting older, you know, there's not a lot of point because that's not really the risk you face. It's the longevity risk. It's maybe the risk of losing an asset. So really understanding how your risk profile changes and how the insurance you have has to change in light of that is important, I guess.
Got it, mate. Thank you. Craig, when it comes to health insurance for retirees, it's just not affordable. For middle New Zealand, it's a great shame and it's a tragedy. If we had $1 for every time someone asked us about how can I make health insurance work for me, I'd be very wealthy indeed. If I had the luxury of throwing one of those darts, I'd throw both of them at health insurance. If in this room we can somehow solve that conundrum and make very basic health insurance available to people aged above 70, it'd be magic. Absolute magic, Craig. But the answer's not clear. Another question, guys? From Sarah. Thank you, Sarah. Would a variety of annuity products not solve the decumulation issue and provide security for retirees where they are otherwise too cautious with asset allocation and spending due to having to manage it themselves? What do you reckon, Joe?
So in theory, yes. there's all sorts of complexities with it, not the least of which is you take on counterparty risk when you buy an annuity. So I'm not exactly sure what the market is like here in New Zealand, but in Australia it is starting to develop, but it's typically organisations that are bank-like and have got really strong balance sheets, because counterparty risk from an asset management perspective is something you've got to be really conscious of. Those products can be expensive, they can be complex, but yes, they potentially can be a big part of the solution as well.
Sound. Pat, what do you think, mate?
Well, reasonably maybe a controversial position in a room like this, but I mean, we already sort of have an annuity in New Zealand Super, because that's effectively what it does. I mean, we've done calculations at the Commission and worked out that the value of New Zealand Super to you between 65 and 90 is about like having an extra $500,000 in savings, and it does take away that longevity risk. So it does give you that guaranteed income right until you die. So in a way, it sort of is operating a little bit like an annuity product.
Yep.
And so for us, we see that as satisfying, much of the market. And so, and maybe at higher income levels, there's a need for other products. But, for us as a policy organisation, we're more focused probably on the middle to lower income parts of the market.
Sound. Thank you, mate. Ian, you know something about this?
Yeah, I guess annuities loved by actuaries and economic professors and a few other people in practice. And we saw, for example, in the UK, when they stopped compulsory annuitisation, maybe 10 or so years ago, very big reduction in the demand for annuities, often seen as poor value by consumers. I think particularly if they're looking at the age 65, it's, to my mind, far too young even if annuities were available. 65 is a very young age to buy one. It is just hard in New Zealand, frankly, to make the numbers work. If you look at the capital that an annuity provider is needed, the range of investments available, the tax position, it just doesn't, and the pretty small size of people interested in it. Given we all have an annuity at age 65 currently, it's just seems too hard. And I love the maths, but I don't think it's likely to be a big contributor, unfortunately, in New Zealand in terms of the typical annuity product as we've seen overseas. But
Ian, don't give up yet, mate. Sarah, as you know, we had a crack at that, and as Ian said, the traditional annuity was expensive. It was linked to bonds, so returns were low. Taxation wasn't efficient, it was fixed, not variable, and there was no liquidity. You tended to buy an annuity and you gave up your capital. So we had to go at answering those three questions with a variable annuity, which uses both bonds and equities to improve the returns based on a pie, so it was tax effectively, and you could liquidate it and walk away. But they still have to be linked to certainty somewhere in the chain. So in other words, if you're buying equities to generate a better return for an annuity, you need to be able to hedge that risk, as Joe was saying. And we really struggled in the early 2000s when interest rates were nearly negative. So by definition, an annuity's got to last, the individual's lifetime, 20 or 30 years. But the variability of outcomes when you're managing variable assets make it really hard. So somehow we could solve that one and bring them back. I'd be a keen advocate for that. Thank you. Liam, 800 per fortnight for 10 years for 35% equity and a 1 million a home doesn't sound like a good deal. That works out to be about 208 grand for income for $350,000 worth of equity. Surely there could be a more competitive product than this. Hear you, mate, and thank you. Good question. There are two types of equity release products in New Zealand. There's debt and equity. So debt is simply borrowing, right? So you borrow from the bank and you repay the interest plus the principal when you sell the house and enjoy it until you sell the house. All good. Problem with that is it's variable for the homeowner. How much they ultimately pay will be determined by the interest rate. For example, the biggest provider in New Zealand, Heartland, in the last 5 years has varied between 6 and 11%. And a 6 and 11% variation can have a huge impact on how much equity the homeowner will retain. Under that model, the bank or the provider will quite willingly tell you that they'll guarantee not to take more than 100% of your house, which is kind of supposed to be a good thing, right? So to answer your question, we've come up with a different model, which is the equity model. We buy a portion of the house in exchange for fortnightly income up to 35%. Liam, if you compare that against the debt model, you'll find they're comparable in cost, but the difference is the debt model doesn't provide certainty. The equity model does, because the homeowner knows how much of the house they'll keep at the end of the period. Ashley, with an ageing population and rising costs, do you see a case for means testing New Zealand super to ensure its long-term sustainability? Thank you, Ashley. Team. It's got to be you, Pat, isn't it?
In a few weeks, we'll be issuing every 3 years, we do a review of retirement income policy. So we'll be discussing this in a bit more detail. I would say probably distinguish means testing from income testing. And the Retirement Commissioner, Jane Wrightson, is on record as saying that she supports income testing. I also support income testing. I think it's the right thing to do. We've got about 44,000 people over 65 earning over $100,000 a year. And so in an environment where, times are tight and you see how tightly other parts of the welfare state are means tested and targeted, it's almost unjustifiable to continue to pay New Zealand super, to people who can afford not to receive it. However, and this goes back to the governance point and also a point that Ralph made, there is real anxiety around changes to New Zealand super, because for 40% of over 65s, New Zealand super is all they have, and for about another third, they only have a little bit more on top of that. So, this is an area where you actually do have to make haste slowly, and you actually have to be very careful about how you go about making change. So this is why, rather than just introducing income testing, I would focus on getting the governance right and then actually doing some work around it. And then over time, and I'm certain we will end up having part of the New Zealand super system income tested, which actually, if you go back and look at the first Labor government, that was the pension system that they had. So they actually had a means tested age pension and then a universal pension at a higher age. So I think that's probably where we're heading.
Sound, mate. Thank you. Joe, what do you reckon?
I think policy is Patrick's purvey, and he has an excellent answer.
Good on you. Any comments from you, Ian?
Yeah, I guess one thing which I think is a strength of the current New Zealand system is actually, I think it's great that people are comfortable working after age 65.
Yep.
They're paying tax, a lot of countries in the world are facing problems with insufficient workforce, and I can see some argument for mean testing, but I really wouldn't like to see discouragement from people continuing to work should they choose to. I think it's great for New Zealand, great for them.
Got it. If there was some way of, partitioning means testing so that the benefits arrive to those who need it most, would be an advocate for suggesting that one way of helping so many middle New Zealand retirees that are suffering with some sort of means testing for those that aren't, just seems logical to me.
Yeah, and don't forget, we already do a lot of means testing for the over 65 population. So there's about 150,000 people over 65 who receive Tier 2 and Tier 3 benefits, and these are quite heavily means tested. They're things like the disability allowance and accommodation supplement and stuff like that. So, and my concern is we're not being kind of honest about that actually we're already, it's because it's fiscal costs. And so, New Zealand super, extra $2 billion a year on New Zealand super spending every year, and that just puts squeeze in other parts of the system. So I think that's the thing that's going to break it.
Sound. Thank you, mate. Helen asks, what age would an annuity be useful or viable in New Zealand? Ian, what do you think?
I think it makes more sense. I mean, I don't want to give a specific age because it depends on individual circumstances. But when you're younger, you're giving up a lot when you're buying an annuity in terms of flexibility. Maybe in your 70s or 80s could make more sense. But as I've said, it is a hard market to establish in New Zealand. Even back in my actuarial days, we would, most of the annuity quotes we did were for annuity surveys. Very few for customers who actually ever took out an annuity, unfortunately, and that was 30 years ago. So.
Got it, mate. Our experience would be similar. Given that we're trying to create a regular income stream for 30 years or so and using variable assets to achieve it, the shorter the duration, the less the risk, easier it is to manage, which I think is an argument for a variable annuity product being available for older people, probably 75 or 80 plus. Guys, any thoughts? Good. Okie dokie. Health insurance is back. Where does health cover come into it? Does a retiree rely on the government system, retirement savings, or health insurance? Pat, looking at you, mate.
I can't really comment on health insurance. It's not an area I've given much thought to. I would say, and this goes back again to the equity release thing, I guess there is a question here about responsibilities, and is it just the state's responsibility or is it the individuals? And if it's the individual, then we do have to look at things like health insurance, but also the use of products like equity release or home reversion mortgages to sort of unleash some sort of capital to sort of, if you want to go private, that sort of thing. So.
Got it, mate. I'm in trouble, we're over time. So with that notion, can I just ask you all to join me in thanking the team for their excellent efforts this afternoon?